So today I'll be talking to you all about U.S. inflation and the core consumer price index. Okay. So inflation as a whole is the rate that the price for goods and services goes up. And what this ultimately results in is a decrease in the purchasing power of a currency. So you can buy, less with whatever the dollar's worth. And it reflects how much more expensive that goods and services have become over a period of time. And I'll be talking to you guys today about month to month, but there's also year to year. And what also is a really top indicator of inflation in the U.S. and also comes out this morning is CPI. So why do we, and that's the price of, correct me if I'm wrong, just basket of goods and services in the U.S.
It's a basket of consumer goods.
Yes.
Tomorrow we'll have PPIs, which is a basket of industrial goods, basically pipeline byproducts that go into the production of goods. Mm-hmm. There's 4 or 5 measures of, there's a price-weighted GDP indicator, there's an employment cost index, which is wage costs. There's lots of different indicators of inflation. Mm-hmm. Any of them the holy grail of inflation? No, but they're all indicators. And again, we're not here to judge which one's better or which one's more predictive. We're traders. We're looking to, okay, where is the opportunity for me, not in the macro aspect of it, but understanding context is good. Now, let's take a look at, why do we look at it?
Yeah, so I think people as a whole, economists and traders, view it as a stable view of inflation and help us figure out what the true cost of living is at the point where the data is released. Now, the bigger reason that, or at least that I would say that people make, such a fuss about it is it can influence the Fed's decision, which is coming up on December 18th when it comes to interest rate cuts due to inflationary pressures. So if we want to go to the next one, I'm going to talk a little bit about recent inflation trends in the last several months.
And that one sentence is the key. So CPI can impact what the Fed does. That affects interest rates, and that affects our world. So that's really the takeaway. So that is what we want to worry about. Mm-hmm.
So as of today, they are forecasting month-to-month inflation at 3.3%, which is consistent with the last couple of months. And then by the end of the quarter, they are forecasting it to be trending at around 3%. Our yearly highs were not hit since last October, November, and that was 4%. So it's highly unlikely that those yearly highs will be really, an issue again for the remainder of the year since it's gone down a lot more. But yeah, that's just an overview of kind of what we've been looking at. It's seen definitely a downtrend over the last several months and gone up minimally since August.
Absolutely. And just as a scheme of reference here, if the print, they're looking for about 3.3%. Mm-hmm. The print's 3.5 or below 3, the market will have a bigger move. If it's right around here, the market won't have as big a move.
And what do you think about the general consensus of the target rate being at 2%? Because you see that number, 2%, this is 2%. What do you think about that?
I think it is, again, they're trying to set a target rate is aspirational. They're trying to set a rate that, again, an economy that doesn't have inflation, a level of inflation or deflation is problematic. The Japanese have gone through this for 25 years now, and it creates a lot of inefficiencies and non-productive economy. So you want a level of price inflation. It means there's demand for goods, but you don't want it at the point of demand destruction. So they're trying, is 2% better than 2.5? They're just picking a number as a goal to set. Will they live with 2.5% inflation? Absolutely. What they don't want is inflation to dip below 2%.
Yeah.
So I think that target rate is just a aspirational goal. It doesn't mean we have to get there for them to change things, as we're seeing, because we're not at 2% inflation and they're already cutting rates. So, but this is where all the inflation, again, whether it's 3% or 2.5%, isn't relevant to us as traders. It is, where does it impact interest rates and the trajectory rates, and that we can directly track back to our currency markets.
And that's great context too, just because it's easy to get stuck on those numbers and be like, well, why are people happy about this? It's not at that one number, or why are people upset about this? And it can sometimes not make sense, especially when you're newer. So to have that context of, hey, it's a number that's meant to kind of keep us in the game per se, and not so much we have to be at this number.
Absolutely. And, I always go back to like non-farm payrolls. So a week ago Friday, and everybody roughly remembers the number and the reaction. A month before that, we had the same non-farm payrolls, and everybody reacted to it. Does anyone remember what that number is? Absolutely not. And that's why these numbers themselves are meaningless. Don't be an Don't be an economist to the extent of worrying about what the numbers are. Be a trader. Worry about how they affect your markets and where you can find opportunity.
Yep, that's a great point. So I got the FedWatch chart up here predicting, like forecasting what the potential rate cut could be for the December 18th meeting. So right now, I believe it stands at 4.75%, right? The current interest rate.
It's 4.5 to 4.75.
Yeah.
They always have a target range of 25 basis points.
Yeah. So we're looking at an 85% chance of it being a 4.25 to 4.5 range.
Right.
And we'll see that if inflation is in line with forecast, the Fed's interest rate decision, there's a decent chance that it won't be very shocking because they want to maintain that stability, and it probably won't be a very eventful situation. But if it's below expectations, there's a chance central banks may lower the rates to stimulate economic activity because it's believe that lower rates can encourage consumers to spend a little bit more.
Absolutely. So in this probabilities, you can go to CME Fed Watch and look at these anytime. Probabilities of the rate cut are applied by Fed funds futures pricing. So this is guys with skin in the game, and they're interpolating that into a probability, which is a great tool. So if the CPI number is dramatically different than expected, these numbers will change, and whether the Fed acts or not, the probabilities around it will be implied in that change. So let's go back to the platform and talk about one thing. We got a couple minutes left. The other binary event coming up today is, what do we have, Bridge?
USD CAD.
Right. So dollar Canada, we've got a Bank of Canada. Oops, sorry, I did that wrong. Bank of Canada, 8:30 this afternoon, 8:30 this morning. We have that's Chicago time, guys. BOC is, I'm going to go to the economic calendar here if you want to see it.
And it's been a rough week for the Canadian dollar, too, from kind of what we've seen hitting lows that I believe haven't been seen since 2020.
Right.
So, yeah, we're kind of looking at a low period.
Right.
Yeah.
So 8:45, the announcement. They're looking for a 50 basis point cut out of the Bank of Canada. That will bring their rates appreciably below where ours are. You just said 4.5 going down to 4.25. There's a little bit of discrepancy whether or not they go 25 or 50 basis points. There'll be a press conference at 9:30 afterwards. What will this do? Again, it depends on whether they cut 25 or 50 and the statements afterwards. So, but they are on. Again, they've gotten some very soft employment numbers last Friday. Their inflation is growing a little bit, though, too. So the argument is, will they choose to act, and how aggressively they will. So if we go to the Canada, we see that the Canada market again flirting with those relatively high levels of 142. If they do cut, the conventional thinking is we'll see a print above 142, but this may be a classic buy the rumor, sell the fact. Now, they put a lot into this market recently. And let's just go back out to the daily. They put a lot of, again, this is a market that, yes, dollar strong basis Canada, lower dollar strong versus euro versus yen at 152. But this is one where it'll be interesting to see, will we get a movement off of whether they do 50 or 25? Sure. 50 is kind of what is expected, probably a muted movement, but if they do just 25, maybe we'll see. You could possibly see a little bit of a sell-off in dollar Canada, which means they're not going to be quite as aggressive cutting rates as forecast. So, a couple of good things to trade off of. Look at your trading ranges, check your positions, take advantage of if we do get a little bit of an outsized move, and how that plays into. So you'll get a move at 7:30 off of all the majors, then one particular to Canada at 8:45. So lots of good trading opportunity today in FX. We'll see you back here tomorrow.